At our strategy, we run a 5-phase cycle framework. We track a core signal stack to map risk, not headlines. This matters because regime shifts change what wins first. This interview frames oil and gas as mispriced on a demand ends soon story. Our focus is different. Supply constraints can arrive late, then hit fast. This is happening because underinvestment shrinks future supply, and when that happens, it usually leads to price spikes. Source is a thoughtful money interview with Rick Rule on oil, gas, and silver positioning. The core claim is that markets may be undervaluing long-duration energy cash flows. The secondary claim is that capex discipline versus cannibalization separates winners from laggards. We translate this into signals like credit and private credit, yields, liquidity plumbing, dollar funding stress, and equity breadth. Then we ask what changes now, who gets hit first, and what breaks first. This is happening because constraints show up in data before narratives change, and when that happens, it usually leads to fast repricing. The direction is that the peak demand soon narrative looks less certain. The magnitude is that the demand tail looks longer. The relationship is that longer tails increase the value of long-life producers when the market discounts later cash flows too aggressively. The implication is that energy equities can look cheap if the market is pricing the tail as near zero. The direction is that sustaining investment looks too low. The magnitude is persistent enough to matter in the out years. The relationship is that less reinvestment today reduces production capacity later. The implication is a higher probability of a delayed supply shock and higher volatility later. This is happening because capital is expensive and incentives favor payouts, and when that happens, it usually leads to future shortages. The direction is that Tier 1 drilling inventory appears depleted. The magnitude is fewer prime locations left. The relationship is that lower quality inventory weakens the swing producer response. The implication is that supply cannot ramp quickly, so prices can overshoot during tightness. This is happening because the best acreage gets drilled first, and when that happens, it usually leads to slower growth later. This changes how we treat timing because this looks like a durability setup, not a quick trade. It also changes dispersion risk, since high payout and low reinvestment companies can underperform in a real supply squeeze. This is happening because dividends can hide depletion, and when that happens, it usually leads to surprise production gaps. If energy tightness returns, high beta tech can become fragile through rates and margin pressure. If oil spikes, inflation sensitivity rises, and liquidity can tighten indirectly. If oil stays low, highly levered producers can be the first to break. The direction is that gas demand support looks more durable. The magnitude is multi-year due to infrastructure and power needs. The relationship is that once pipes and export capacity exist, utilization can become annuity-like. The implication is that gas can stay strategically relevant even if nuclear grows later. This is happening because grids need flexible fuel when demand spikes, and when that happens, it usually leads to gas being the shock absorber. Consumers and energy-intensive businesses feel it first through prices and volatility. Regions with tight grids and policy friction feel reliability stress earlier. This is happening because constrained supply meets inelastic demand, and when that happens, it usually leads to political and market reactions. We separate the sector thesis from company survivability and reinvestment discipline. We stress test balance sheets, jurisdiction risk, and sustaining capex behavior. We define invalidation triggers and size in tranches to keep optionality. This is educational content, not financial advice. We share probabilities and process, not buy or sell instructions. Your situation and constraints matter. Near term, timing is uncertain, so we do not anchor to a date. Medium term, underinvestment raises phase 2 pressure and late cycle sensitivity. If energy tightness feeds inflation, phase 3 risk can rise through tighter conditions. This is happening because supply shocks tighten financial conditions, and when that happens, it usually leads to broader repricing. What changed is that we weight energy durability higher and watch reinvestment versus cannibalization more closely. What did not change is that we still need confirmation from credit, yields, liquidity, and breadth. This is happening because one theme is not a regime, and when that happens, it usually leads to false starts. The bottom line is that this is a when versus if setup, with time as the key variable. We keep optionality and let signals confirm before sizing up. Source is thoughtful money. Background is generated via prompt 2.